Earnings yield is a financial ratio that measures the earnings generated by a company relative to its stock price. It is the reciprocal of the price-to-earnings (PE) ratio and is calculated by dividing the earnings per share (EPS) by the current market price per share. Here's how earnings yield works and some key points about it. One calculation, earnings yield is calculated as follows. Earnings yield equals earnings per share, market price per share. Alternatively, it can be expressed as a percentage by multiplying the result by 100. 2. Interpretation. Earnings yield represents the percentage of earnings generated for each dollar invested in the company's stock. A higher earnings yield indicates that the stock is relatively undervalued or has a higher potential for generating earnings compared to its market price. Conversely, a lower earnings yield may suggest that the stock is overvalued or has lower earnings potential. 3. Comparison. Earnings yield can be compared across different companies or sectors to assess relative valuation. Investors often compare the earnings yield of a company with the yields of other investment alternatives, such as bonds or other stocks, to make informed investment decisions. 4. Inverse relationship with PE ratio. Earnings yield is the inverse of the price-to-earnings (PE) ratio. As the PE ratio increases, indicating higher valuation, the earnings yield decreases, and vice versa. This relationship reflects the trade-off between the price investors are willing to pay for earnings and the earnings generated by the company. Number 5. Risk consideration. While earnings yield provides insights into the valuation of a company's stock, it does not account for factors such as growth prospects, risk, or future earnings potential. Investors should consider other metrics and qualitative factors when evaluating investment opportunities. In summary, earnings yield is a useful valuation metric for assessing the relationship between a company's earnings and its stock price. It provides investors with a simple measure to gauge the attractiveness of a stock relative to its earnings potential and can help inform investment decisions in the context of valuation and risk.